Hi, guys. So I want to give credit to someone right now. This guy is budget for life. He has a channel, not much, maybe like 400 subscribers, but he's a financial bro and he's breaking down GameStop sheet. Okay. Now I fast forwarded to about 16-minute mark. It is very long video. Don't get me wrong. But if you like GameStop, you'll like the video. Additionally, I'm going to play it at 1.5 because he talks really slow. It's nothing against you, Jeremy. I know you get excited. I'm excited for the news that's being said in this video, but this guy has a financial background, and he's basically doing all the deductive reasoning that we've been doing for so long as GameStop investors. But I want you to hear it from somebody else, guys. This guy has a unique way of looking at the investment called GameStop, and he's breaking down the numbers that you should all know. This is information everybody should hear. I know our platform's a little bit bigger than his, so what are we going to do? We're going to push him out there. We're going to get him up front and center so people can actually get the info that he is putting out. It's called GameStop's Endgame is Here, without a doubt. And he's going to explain to you why GameStop should be trading well above $100 a share, $300 a share, and vice versa, and keep going. So let's watch it.
But they've made enough improvements from negative $380 million loss, right? Over that next year, $70 million improvement. Over the next year, a $320 million improvement. Over the next year, another $125 million improvement. And this year, they're on pace for probably another $400 million improvement on net income. So, but this year, the full year 2024 was really when they're like, okay, we have some space, we have some wiggle room, right? We're not just barely going to squeak out a tiny profit, but actually we are.
So as you guys know, I projected for this year coming up, we're going to do 525 million. I think we're going to grow another 400% based off of last year's number. So that's huge to go from losing $500 million to now positive $500 million. You're going to be at, a net gain of a $1 billion swing on net profit for GameStop. But it's a growth number that he's going to explain right now. So go for it.
Profitable from a net income perspective, but profitable from an operating income perspective, which you don't see it on their full year numbers. And that's because this includes their Europe and Canada stores, which are Canada's already off the books and Europe is listed for sale right now and will sell this year. And so what remains of their retail business, United States and Australia, is already operationally profitable on a trailing 12-month basis, which I'll show you that here in a second too. But you see this transition happening where now they have money available to start investing in their business rather than just trying to save every dollar they can and shrink their business. And so what starts to happen in 2024? Well, one thing is they start to raise cash. So at the end of, at the beginning of the year, a year ago, basically, a year and a half ago, they had $1 billion in the bank. Fast forward 15 months, they have over $9 billion of cash plus Bitcoin in the bank. They are on pace to almost 10x. Well, really, they are on pace to 10x in over 2 years. By Q1 of 2026, they will likely have over $10 billion of cash in Bitcoin. So they're raising money because they are ready to begin expanding, right? There's no use in raising money before because their operation as a business was still struggling, was still unprofitable, was still too large. But now they're saying, hey, when the time is right, we are going to acquire businesses. We're going to become a holding company. And in the meantime, at the very least, we're a really efficient capital raising hedge fund because how many companies is there a demand out there to where if they want to raise $10 billion at a 0% interest? Well, this one was dilution. So they sold shares, about $3 billion worth at the beginning of 2024. But then after Q4 of 24, they raised 1.5 billion at 0% interest, 5-year term debt. Then they raised another 2.7 billion, 0% interest, 7-year term debt. And they have another 1.9 billion coming, which we'll talk about in a second. But you'll see, so they start raising cash, right? And they're not done. They're gonna keep taking all the free money that people want to give them. And you see their continued efficiency from an SG&A perspective, still shedding money year over year. Look at this. Year over year, Q1 to Q1, that's a $70 million decline in just one quarter on SG&A. Q2, another $52 million decline. So they're on pace to shed another $200 million in 2025 on their SG&A. And this is despite this huge, awesome transition point, which is officially moving into sales growth, revenue growth. So this whole time in 22, 23, 24, their net sales was declining, right? Decline, because they're getting smaller, right? And because video games are selling less and less, right? From a percentage of their company sales, it was 52% in 2018. Software, meaning basically hard copy video games. And it's gone down and down and down to where in this quarter it was 15%. So they have seen what was the majority of their business. They have seen it crater over the past 5 years. And yet they're on pace to make probably over $500 million of profit in this year alone. They're already at a trailing 12-month operational profit, and that's going to continue to increase as well. They made $300 million of free cash flow in just Q2 alone. That's from their core business. So their cash, like they're continuing to raise more and more cash, and their ability to raise more cash is showing no signs of slowing down. So what does that do to the floor valuation of your business, right? When you have more and more money in the bank, it's hard to say that the money's not worth money, right? You can argue about what multiple you want to give GameStop, the retailer, but it's hard to say that their money is worth negative money, right? It's like the company's got to be worth at least 9.2 billion, right? But then you have sales that if you look at this year over year, Q2 to Q2, this would tell you that sales grew 22% year over year. In reality, they grew much more than that because, again, this number is including Canada and Europe, which they are phasing out of. So if you just take their business, United States and Australia, it's like, well, United States increased by 33% year over year, sales growth, top line growth. Australia grew 60% year over year. So on a weighted average basis, that's probably like a 38% sales growth year over year. That's huge. That's booming type numbers as it relates to a company. And their cash, right? 1,000% or 900% growth in cash year over year or whatever, over 1.5 years. Crazy, crazy bullish momentum as far as how far could this go? How much money could they raise? But also how high their floor is getting as far as what's the downside risk of GameStop is getting lower and lower and lower the more that they raise cash if their market cap fails to appreciate in the same pace as their cash that they're raising. Um, so this 200 million, this sales growth, a lot of this quarter is from the Nintendo Switch 2, which this is our first quarter to see the impact of those sales. You'll see they raised 250 million. They sold $250 million more quarter over quarter in hardware. So that's consoles. So the Nintendo Switch 2 doing awesome numbers. It's going to continue to do awesome numbers for several years. We also have a console cycle with Xbox and PlayStation on the horizon. And then their collectibles business year over year is growing at 60+%. And that's just the beginning of this trend. The consoles are cyclical. When new consoles come out, they sell a bunch, but eventually, 4 years from now, it's going to be hard for GameStop to sell the same dollar value of consoles because these consoles have been out now for 4 years or 3 years or whatever. But the collectibles business, that's mostly trading cards, and that business is at all-time highs globally, and GameStop's beginning to enter into that business is at the very, very, very early stages. And so likely, well before we see the tail end of the console cycle, you're going to see hardware sales rise and rise and rise for probably another 2.5, 3 years. But when you see them begin tapering off into year 3 or 4, the collectibles will be growing. I mean, it's on pace to more than usurp any of those losses from kind of aging consoles. And then, of course, there will still be another console cycle, right? And that will boost that business again. But GameStop's intention is, hey, let's get less cyclical and less. These are also low profit margin sales. So this $250 million of this, 1 billion in sales, about a quarter of that was at a 5% profit margin, right? So they would.
So also pay attention to what he said, guys. If you guys like tucked over, if you didn't listen, he said that GameStop came in at 972, right, on revenue, but they don't have the French stores anymore, and they don't have Canada anymore. So how much did they really grow as far as revenue? It had to be a lot bigger than the number of 732. If you backed out Canada and Europe, basically all of Europe, but Canada and France off of that 732 number, that number wouldn't even be that big. That number would be something like 600 million. And then you'd take GameStop's 972. They grew so much. They probably grew on a rate of around 40% on revenue just for this quarter. It's much bigger than people could care to ever think about. But that's why your collectibles number is so much bigger as well. When he's showing you 227 versus the 211, you got to back out Canada. You got to back out anything overseas. So numbers are big. Numbers are massive. But remember what we tell you about consoles too. The software number goes up as the console cycle gets a little longer because people buy more video games for the consoles they just bought. They traditionally don't get to buy all the titles of games, that first day that it comes out. But throughout the year, throughout 2 years, Nintendo will release more games, and then your software number will go up. So I just wanted you to see that part. We'll keep going.
Much rather sell trading cards that they're selling for probably 40% plus profit margin on average. And that's going to continue to be a larger and larger portion of their business. But regardless, their total business growing almost 40%. And the most important part of their business is growing over 60% and just beginning. That sales number, that percentage growth number is going to increase for at least several more quarters. So very exciting to see where that will scale to. But overall, they've raised a bunch of money. They've officially transitioned into we are growing as a company. And here's what's super exciting, guys. Simultaneously, despite their total sales growing, they are continuing to shrink their store count. So we don't know the official number until their 10K comes out next April, but you can value approximately how many leases they still have under contract. Based on their balance sheet, they have right of use assets and corresponding liabilities. So you have a grid for how many leases do they still have. They have probably shed over 1,000 stores just in 2025, just in the past 6 months, right? So they've cut another 35% from their operating costs, and yet their sales are higher. With 2/3 of the footprint, their sales are higher. So what does that mean? Their business, right, from just the US and Australia, you're seeing sales growth of 38% or so. But if you adjust for the stores, where is this? What do I want to see here? The sales per store growing over 110%. And that's not even netting out Europe and Canada. If you net out Europe and Canada, this might be more like 200% of actual store sales per store growth. Does that mean a bunch more people are coming into stores? That's a little bit of it, but the more important trend is that GameStop is shifting more and more of their customers online. More and more of their customer base is online. They are continuing to decrease their footprint, and yet their sales are increasing, which is having a dramatic effect on their efficiency as a business. And also these SG&A numbers and these cost of sales numbers, these are going to continue to come down because these include some one-time store closure costs, for example, that GameStop's not going to have a year from now. These include some costs of operating some stores that were at a break-even rate.
If you remember Q1, we had an asset write off of 35.5 million. So it was included on the SG&A end line. So if you would have taken that out, the 35.5 on earnings themselves, we wouldn't be at 370 right now like we are on the trailing 12. We'd be closer to 400 million of profit on trailing 12. So big numbers to look at, considering also on cash. We are at $11 billion. I know people don't know this because the warrants haven't been released, but GameStop's basically telling you we're going to be $11 billion. We're going to put these out. They're going to get exercised. They're going to trade, but you're going to generate cash based off of those warrants. So, yeah, that's what you're looking at. You're looking at a company that is $11 billion of cash. You're looking at a company that has extreme growth per store. I've been talking about this with you guys, but to see it on this spreadsheet that I like this guy's spreadsheets, it comes out to massive growth, right? Just growth store over store and leaning on the collectible side, but also understanding that GameStop cleaned up the books, 2018, 2019, 2020, 2021, 2022, all those years. They were looking terrible. They were looking god awful. But the thing was, you had to clean it all up before you could actually invest into it. Now they have this multiple. Now the only thing missing is Wall Street. That's the only thing missing right now. You can see all these percentages of increase. And I'm going to let him explain that part too about Wall Street not giving it fair value, and much better than any Tony De Niro video. I promise you that. Let's go for it. This guy's by the name. His name is Budget for Life. Is all one word? Is the YouTube channel. His name's Jeremy. Let's go, Jeremy.
That GameStop's going to have off the books a year from now, and then another year from now, right? How few stores can they get to is the fun game that GameStop gets to play. Right now, they're probably going to finish the year at less than 2,000, and how low could they get? Could they get to 1,000 and still continue to grow as a company? If so, that increases the cash flow that they make. It increases their efficiency, right? Their profit margins, of course. So that improves the valuation of the company, right? If they're going to be able to make more money at a more efficient clip, that's going to improve their valuation. But more importantly, it also warrants an increase in multiple, because an online retailer is generally going to be more efficient, more scalable, I should say, than a physical retailer. There's only so much that a Home Depot can do to scale its growth, where Costco can do to scale its growth, unless they build more stores, right? But when you're an online retailer, it's like, well, shoot, something could happen overnight. A product goes viral and your sales could triple, right? That's a little bit of a dumbed down example, but an online retailer, from a price to earnings or price to sales basis, on average is going to warrant a higher earnings multiple. So it's going to raise GameStop's earnings. It's also going to raise GameStop's multiple. And really, it already should, right? Because you already know this is happening. You can see this happening, right? They had 6,000 stores 6.5 years ago. And now they have close to 2,000 stores. And they're not done. They've said in their 10Qs, we're not done closing stores. We're going to keep evaluating stores to close. And we're not going to tell you how many we're going to close, but you can already see
I don't know where he got the 2,000 stores from. I know he's saying that all of Europe is going to be gone. I've only known about portions of Europe being sold off, not all of it. But if it's down to 2,000, these are godly numbers, right? But I think it's somewhere. I'm gonna cut it half. I'll meet you halfway. I'll meet you at 2,600. So, but these are good numbers. I mean, either way, keep watching.
I'll just kind of show you the right of use. Right of use assets
Yep.
right now, 249 million compared to just a year ago, 490 million. So this is whatever exact number you want to pick, go for it. But this is representative of just how much they have shed their store count in just 1 year, right? And they're not done, right? So they're going to get more profitable and just find even higher multiple, right? Super exciting. The collectibles business growing at 60+%, sales per store growing at over 100%, and their market cap right now, again, less than what it was when they were bleeding money, losing $400 million a year. So they make $1 billion more per year right now as a company than they did 3.5 years ago. And they are worth less than they were 3.5 years ago. How sustainable do you think that is? They have 10 times the amount of cash that they did 3.5 years ago, and they are worth less than they were 3.5 years ago. Their growth exceeds that of even some of the almost every growth oriented company. GameStop's growth rate is they're growing even faster than them, and yet they're worth even less than they were 3.5 years ago. And the trend of all these numbers is up. The trend on their sales is up, right? It's going to be even better and even faster for at least several more quarters. The trend on their cost of doing business, right? Their SG&A is down, and it's going to continue going down for at least several more quarters because they're closing more and more stores, right? The trend on their cash is up, and it's going to continue going up for at least several more quarters. And yet they are worth less now than they were 3 years ago when they were in the middle of the thick of the muck of this is going to take some time, even if we succeed. And now we're actually into the stage where you're seeing some of the bona fide success of the business, and still with the most exciting upside still to come, which really comes down to how do they deploy all of this cash that they're raising, and what's the impact of trading cards on their business. So you can see right here their Power Pack launch. So we don't even know the numbers of this yet. Okay, just in Q4, 3 quarters ago, they announced a partnership with PSA. Nat Turner joined the board of GameStop. PSA is by far the largest, most trusted grading company for cards, Pokemon cards, sports cards, etc. And they are in cahoots with GameStop, right? So for this booming industry that's selling at all-time highs, that's growing, thousands of percent compared to, a decade ago, they are making it very clear that, hey, this is our preferred retailer is GameStop. And so it's going to be very hard for any other company to compete with GameStop as far as who's going to benefit the most from this business. So if you want to get your cards graded, it's cheapest and most efficient to now get them graded through GameStop. And then GameStop's going to give you an instant offer, right? If you want to sell, right? GameStop's the buy and sell, the trade-in store, right? Hey, we just got this card graded. We'll buy it now from you for 90% of the retail value, and you can just cash it in, and voila, now you can have more money to buy more cards. Their Power Packs, though, they haven't. So anyways, GameStop has been selling cards, and they've been doing grading, and that is the primary reason you're seeing the collectibles business grow at 60% year over year, is this partnership, which is in a very soft rollout, a very slow rollout perspective. So they're selling cards in store. So people go to GameStop to buy cards, right? They wait in line out the door when a new Pokemon release comes. They get their Pokemon cards, right? They go to GameStop, buy some cards. Then, if you want to get the cards graded, the cheapest, most efficient way to get your cards graded is through GameStop. And then if you want to sell your cards, the cheapest, most efficient way to sell your cards is through GameStop, right? You could say, well, why don't you sell it through eBay? Well, eBay takes a 16% fee on all consumer sales. So if GameStop's giving you 90% of the value, so they're only taking a 10% fee, and you get the cash right now guaranteed. Compared to eBay, you have to list it. You have to hope that you get, offered whatever you listed it for. And then even if you get full market value, you're only netting 84% of the value compared to your netting 90% at GameStop. And GameStop's immediately available right now. And the quickness of that is super important as far as how much can this scale. So you're buying your cards from GameStop, and then you're grading your cards at GameStop, and then you're selling your cards to GameStop, and GameStop is selling your cards for a profit margin. And here's what is Power Packs. I could probably just show you real quick. So Power Packs, basically, you get to spin the roulette and say, hey, just give me a blind card, right? I want to spend either 25 or 50 or $1,000 for a blind reveal of whatever card I might get. So GameStop is basically selling like after you sell your card to GameStop, they are now going to sell your card for a guaranteed profit, right? They can skew these numbers to where they're going to make money on average, right? It's like a casino basically. So the house is always going to win. But what's cool is that they can continue winning with the same inventory because when you pull a card that's $8,000, they'll say, "Hey, we'll give you 7,200 right now." And so you can pull the card, win the card, and then sell the card right back to GameStop. So GameStop never even had to deliver it, right? Then they didn't have to ship it to you. They get the same inventory immediately sold, immediately repurchased, and then again and again, right? So then it stays in the log and they can continue selling the same card to more and more people. And the only cards that they lose are the cards that are piling up in their inventory that they don't want anymore, saying, "Oh, this $5 to $15 card." Well, that's really where they make honestly even more money because you just spent $25 on a card that's worth $10. And are you going to pay $10 to ship a $10 card to yourself? No, you're probably not. It's almost more likely that you will sell the losers back to GameStop, which means all these cheap cards are going to make GameStop a ton, right? As long as they can still have some expensive cards in the hat to keep the game going, which who is more able to source cards than PSA, right? These are all being sold from PSA's vault. So GameStop doesn't even have to own all the cards. It's all the cards that PSA themselves own. So it's like basically every graded card that in like practically in the universe, GameStop gets first dibs on selling them. So GameStop's selling them on PSA's behalf, basically. GameStop's getting transaction volume. PSA, I'm sure, is getting a cut as well. All that to say, this is still in beta, and so we don't know how much money this is going to make GameStop. Well, beta started in Q3, so we haven't seen any impact yet of what this product is going to do for GameStop. What we do know is that GameStop did some physical power packs, like they made packaging, like, and they put a slab and a PSA graded card in there, and they put a couple other just like booster packs in there, sold them for $50 a pop in stores. They did it 2 different times, both times, lines out the door, and they sold within the same day. Like they sold out both times they did them.
And don't forget on that part right there that GameStop had like 9,000 cards online at one time, 4,000 cards online at one time, and they went ahead and made those power packs with the inventory they had on the website. As of today, the inventory on the website is basically nothing. It used to be 9,000 something cards online. What I'm guessing is they put all of those cards. Look at this, 788 Pokemon cards, basically nothing. I'm guessing they took all those cards and they put them in the inventory at the vault, and that's what they're churning through. So there's 15. Well, the majority of it, 1525. They only have 1,525 guys. They had 1,700 yesterday. They're selling hundreds of cards per day on this website, but the special thing about the PSA partnership that they have is those cards. Some of them are ones that you can't get from GameStop's website. So I just want to put that out. Some are not 8, 9, and 10. Some are really old school cards, 5, 7s, 8s, and those are the fun ones. Those are the ones where you get an old school card and you don't even know the value of it, but it's still there. So we'll keep going.
So we know that the demand for basically people would rather be lucky than good. They don't want to scour eBay for maybe I'll be able to find a card that's a little bit undervalued and then I can relist it and flip it for $5. No, I just want to play the game, right? I want to spend $25 because I might get $500, right? Even though I know that the odds of that are so low, that is more fun and it's all online and it requires no work. You don't have to get the card in the mail and then relist the card and then ship out the card. GameStop does all the work for you. All you have to do is click this little button, right? So we know that when they made physical power packs, blind reveal, graded cards, that they sold out high demand same day. We will see in Q3 how much this continues to grow the collectibles business, but only on a beta perspective. A lot of people can't even get into this yet. It's not publicly released yet. So it really will be Q4 or Q1 of next year, right? Whenever they're ready to release it to the public, that we'll begin to see how much is that going to boost their business numbers. And I just want to say that when you're dealing with year-over-year numbers of less than $1 billion a quarter, iterations like this are so meaningful. $100 million is a lot of money to GameStop as far as operating earnings. To Target or to Walmart, it's like, oh, cool, we sold another 100 million. No, our investors cannot even benefit from that, right? It's a tiny, tiny, tiny fraction compared to what we're doing with grocery pickup. So it just doesn't even matter. But to GameStop, it's like, this is our business. We're going to build our business around this. And so the upside is huge. And the downside is negligible because they can cook the books, right? If let's say, oh, what if the valuation of their inventory goes down a little bit? what if this player is not as popular anymore, and so now their card is worth less? It's like, well, great. They can then adjust the. They can make sure that they're selling it for a nice margin and continue to flip it, sell it again, and they're not even putting themselves on the hook oftentimes to buy the inventory, although they do hold some cards in inventory as well. All that to say, awesome operational progress. And again, even if you wanted to net out the cash, their operating income year over year up 265%. And again, it's really more than that because this still factors in Europe and Canada. 265% operating income. That doesn't even factor in the cash, which when you factor in the cash, their income is up over 1,000% year over year. Just awesome. Just awesome. Now you might be wondering, what is this debt versus dilution? So they raised in total $4.2 billion through convertible bonds. So basically, GameStop has the option in 5 years and in 7 years to just pay back this money, or they have the option to grant shares to the people that loaned GameStop the money. So they can pay with shares, so that won't cost them any cash, but it will dilute their share. It'll add to their share count, or they could just pay back the cash. So that affects their balance sheet. Probably they will dilute. Okay, but let's just say, for argument's sake, if they wanted to pay back the money in cash, and it's like, okay, well, that means they have $5 billion total of debt. So that means their assets minus their debt is 5.2 billion is their book value. But if they dilute, then they really have less than $1 billion in debt because they don't have to pay back any of that money. The 4.2 they don't have to pay back, and that means their assets minus their debt gives them a book value of about 9.4 billion. That matters as it relates to their valuation, because again, as you can see, if they dilute, this number right here basically implies, like, what if they were already fully diluted right now? And like, let's say that that's just being baked into the stock price. So, okay, the stock price, if it's $25 a share, that means based on their share count of $447 million, gives them a market cap of 11.2. But what if people are really just valuing it off of their total diluted float of $546 billion? Well, that means that their market cap is really 13.6, if you want to think about it that way. But then if you net out the book value, a 13.6 market cap means that their business itself is being valued at 4.3 billion. So if you just take out the cash, they're saying, okay, 4.3 billion is the worth of GameStop as a company, which from a price to book is 0.46, a price to earnings is 11.83, price to sales is 1.11. But these are all like this is trending even lower because the book value is going up because they're raising cash and they're operationally profitable. This is trending lower because their sales is growing at 40+%, right? And this is going, well, sorry, the earnings is growing at 1,000+%. So this is crashing, right? The price to earnings, when GameStop was going for $11.5 billion, they wouldn't even have any earnings. So, I mean, they had negative earnings. So their price to book was 6.2. So what's that? Over 13, an $11.5 billion market cap implied 13 times higher a price to book valuation. It implied a time and a half from a price to sales. And that was with a declining sales number, right? Everyone knew that GameStop sales was going to go down. GameStop was saying their sales was going to go down. And yet their price to sales was worth a time and a half 3.5 years ago, what it is now when their sales is growing really aggressively. Their price to earnings doesn't even come online until 2 years later. Is that 2 years later? 2 years later, they finally hit a price to earnings, and it's 313 to 1. So if you bought a share of GameStop in 2023, from a PE basis, you were going to have to wait 313 years to make your money back within the business. Of course, everyone knew that that was trending down, but look how much it's crashed. The price to earnings with GameStop is now at 11.3, and that's factoring in, again, the unprofitable Europe and Canada stores are still weighing on this. So again, if you net that out, it's even lower, and it's trending even lower because their earnings is way higher. Like, what am I trying to say? Like, the year-over-year growth of their earnings is going to be hundreds of percent for several more quarters, right? Q3, they made $17 million. They're going to make probably 500% more than that in Q3 this year, maybe more. I don't know. Again, Q4 is at $100 million. They're going to make way more than that. So that's going to imply, basically, if GameStop's market cap doesn't go up quickly, then, I mean, it's already just such a steal now compared to where it's trending. But if the price continues to stay flat, it's just going to be even more of a steal and even more of a steal, is what I'm trying to say. Like, if you go to some industry benchmarks, the price to book right now, this is not the adjusted number, right? So this is really using the, if you don't net out the book value, like the retail market cap, which is the market cap net of their cash value, which is what I describe as their asset management market cap. They're basically a $2 billion company right now, 1.4 price to book, which is less than everyone in the industry by a wide margin, right? So even if say, hey, just give me the lowest retail price to book you can think of. Oh, so I would be worth 3 times as much. Oh, in the worst case scenario, I'd be worth 3 times as much. Okay, that's not bad. From a price to earnings basis, this is based on earnings of 150 million, but we know that they're on pace. Just within a couple more quarters, like 2 more quarters, this is going to be about 550 million, which means at that point, their price to earnings is going to be at a 3.5, right? Just 2 quarters from now.
So if you guys are not familiar, when he says price to earnings, he's talking about the business side of it, not the overall, not the whole thing. Because remember what we say, you minus out the cash because cash is discount per share. So what he's saying is you're going to get a 3 PE ratio on the company minus the cash. Because if I'm getting $20 a share cash, how much can I buy this company for on top of the cash price? Because I'm buying cash for cash, and you're making $500 million. How much is it going to take to get to the $2 billion market cap that your company's worth? Assets, liabilities, all added up. So, yeah, GameStop's completely lopsided on value, and that's what they're going to show you. Keep watching. This is my favorite part of the video.
And I mean, even where it is right now, it's already still lower than, again, everyone in the industry. And it's trending way lower, right? So do you want to wait till the exact quarter? I'm like, I don't know. I don't know if you want to wait, because if you know it's heading here, which you do, not 50 million, 500 million, then all of a sudden your price to earnings, where am I? Here we go. Your price to earnings is okay. So if I'm given the worst PE in the industry, I'd be worth 4 times as much as I am right now. So my worst case is a 4x upside, right? From a price to sales,
$100 a share.
Okay, you've got Best Buy. Well, this is all again, this is based on numbers that we know will be higher. We know their sales are going to be higher in just 2 quarters. But again, just for argument's sake, Best Buy's been on the decline for a long time, which, by the way, if they go under, do you think that's going to help GameStop? You think that's going to help GameStop for the only other gaming-oriented specialty retailer to go out of business? Yeah, I think it would. But their sales and their earnings have been on the down for years and years. So that's why their price of sales is valued so low. Just give me a single stable retailer. Oh, my floor is 2 times higher, right? Worst case scenario is a 2 times upside. Okay, so it's just not it's not that hard of a decision as far as what's the floor, because the floor, again, the floor is higher than where they're already trading, which then again just it takes you back to this whole conversation of 2018 to 2020 and what really happened behind the scenes and how is the plumbing of the market so powerful, right? How are derivatives able to control the price of a company for so long when it's so obviously disconnected from reality, right? Back here, it was disconnected from reality in a positive way. Why would this company be worth so many times more than what anyone reasonable would think? And then how could it be worth this low in Q2 2025? Way lower than what anyone reasonable would think it's worth. Which, by the way, some other just general company updates, institutional ownership has grown over 100% in just the past year, right? So institutions are buying back in, doubling their positions year over year. Incredibly exciting. Ryan Cohen has begun talking some smack, doing some interviews on CNBC, tweeting. He just tweeted after this earnings. He said, not bad for a piece of crap retailer. So that's exciting. Of course, anytime a CEO is being that, it could be, it's not always exciting. Sometimes CEOs talk smack and it's not in connection with their performance. And it's a little bit like, this guy's just a showman. But in this case, actually connected to this company is doing an amazing job, right? And another just exciting thing from this quarter is that they issued a warrant dividend, or they announced that they are going to issue a warrant dividend. So basically, that's the mechanism by which they're going to raise another $1.9 billion. But they're giving every shareholder on a 10-to-1 basis, 10 shares for 1 warrant. They're basically granting them a call option that expires in October of next year with a strike price of $32. So not to get into the weeds of the technicals of this, but super bullish for several reasons. On the most fundamental level, it shows that management thinks that they will be trading at least 40% upside compared to where they're trading right now at hovering around $25 or $24. So there's implied 40% upside that the management feels will be materialized in just the next year. That doesn't mean that's the best case scenario. That's like the what they perceive as the floor, right? Is we'll be worth at least that, and we're going to grant our shareholders an opportunity to buy a share for $32, meaning we think the shares will be worth more than $32, and we're basically going to give a vesting option to our shareholders. So it's bullish from a fundamental perspective, the way the management feels about the company. It's also bullish from a technicals perspective, as far as smoking out short sellers. Anyone that is rehypothecated shares or is basically naked shorted beyond the total float of shares outstanding, which shouldn't be allowed in the first place. But regardless, it's going to cost them a lot of money because they still have to provide the warrants to shareholders. And so if there are any shares out there that are like funny shares, well, they still are on the hook to pay that warrant dividend. And so that can cause some more pain at the very least to short sellers. And it could cause a squeeze in and of itself because the warrants themselves will have their own ticker and will be tradable on the New York Stock Exchange. And so you'll get to see the value of that warrant that will probably grow over time as the company continues to grow in valuation. So the floor of the company, it's hard to imagine them being worth less than their cash value. And their cash value, if you add 2 billion, right? Like they've already announced we're raising another 2 billion in cash, which is what will happen when those are exercised. That puts their cash value above their market cap right now on just a raw market cap basis. And their upside, it's like, well, man, what if their book was actually valued like, industry average? What about Chewy? Maybe I wonder if the founder of Chewy could run GameStop. I wonder if he'd be able to create a similar value in a company. Oh, we have the founder of Chewy. Oh, cool. So if we're given the same price to book or the same price to earnings as Chewy, an online retailer with a passionate customer base and a growing sales figure, oh, you're telling me that that's this one is actually not calculating right, I feel like, times K3. Oh, this is, anyways, maybe it is actually. Regardless, it's like this, I'll check on those formulas. But the upside, and again, then you have the asset management business. What if people begin to respect GameStop as a hedge fund? What if they begin to respect their ability to raise cash at a rate far cheaper and far greater in value quantity-wise than other companies? What if GameStop begins to deploy some of that money and people respect Ryan Cohen and their investment board from like almost like Carl Icahn or Warren Buffett perspective, where they're given a premium as far as the value of their dollars, because people know they're going to be able to make more with those dollars than just if someone was sitting on dollars. Well, all of a sudden, if they're valued similar or at least industry average to other asset managers, and you begin to take into consideration both for the company as a whole, it's like, well, man, if you just make us industry average, we've got a 1,000% upside, and if we hit the high end, we've got a 14,000% upside. Like on a per share basis, GameStop could justify right now, for example, a $300 per share valuation. Like these are based on right now numbers. If you just give GameStop kind of relative industry standard valuation figures. So if GameStop 3 years from now, the earnings are way higher, again, that's going to just raise this even more. This is based on kind of like right now numbers. What multiple do you give GameStop right now on a price to book or on a price to earnings? Again, I need to look at this because I think it's messed up. But regardless, on a price to earnings basis, right now they can be worth well over $100 a share, and their earnings are going to go up. Right? Again, even just 2 quarters from now, we know their earnings are going to be like 500 million. That's not so far out. That's not projecting new businesses. That's just the pace that they're already on right now. And again, you're looking at hundreds of dollars a share upside right now on a sales basis. Again, huge upside right now. How much is that?
I love the way you keep saying right now. I love that. Yeah, right now it's worth more than the price they're giving you. They're on all metrics, right? All measurables, and we've said this before. The multiple given to GameStop is below the industry average. Period. They are below every single company that mimics what they do. The cash on hand being the asset side, every company there is getting a 2 to 3 to 4 times the cash in securities. GameStop in this case is given 0 because no deployed cash, right? We've talked about this. But when they deploy it, what multiple do you give them? You have to give them that asset management multiple. Another one is going to be price to book. I've been talking about this for 3 years. And people tell me I don't know what I'm saying when it comes to book. No, there is no doubt in this world everyone gets to trade at a multiple on PB. It wouldn't even be a metric if that weren't the case. But I'm telling you how bad it is for GameStop. We trade less than 2x, minus the cash, right, on a net position. So even if you saw GameStop from way out here to there, it should be trading 5x book. I've already said that. Look at the average. Best Buy's 5. Everybody else is 5 to 85 from what you see on this chart. So even if you gave them, but you have to give them a multiple higher, and I'll tell you why. Because all of that is brick and mortar. And GameStop's not necessarily brick and mortar, not by the business model that it is. You guys have to take into consideration the online.com and, of course, Power Packs, but they have a good integration of online and physical stores. So I'm looking at GameStop getting a multiple of 10. I'm just being fair with everyone out there. But if you gave us a 10 book times, we'd be over $100 a share. Then that would put us into the S&P 500, and you already know how that's going to go. It would take you from 100 to 150. Easy, tomorrow. So, yeah, let's keep talking.
That upside going to continue to grow. It's going to be related to how much GameStop continues to grow. But I was wondering, like, what premium is placed on the S&P 500? Because, by the way, right now, GameStop's not even in the S&P 500. If you add that as a fundamental boost to the company, then it's like, what does that do, right? And it probably does some awesome stuff. But right now, the sales growth rate on average of the S&P is 5%. 5% sales growth, and they are given a 3.29 price to sales from a valuation perspective. So if you were growing at 35 or 40%, or we know their sales per store are going over 100%, do you think your price to sales would be higher or lower? It would be higher. The faster your sales are growing, the more of a premium you're going to trade on a price to sales basis. Because if you project out that growth rate, it's not going to take you as long to make the money, like to make your money back, right? How many years of forward sales are we projecting? A 5% growth rate in the S&P warrants a price to sales of 3.29. Our growth rate, GameStop's growth rate, is 7-8 times plus higher. 8 times higher. And yet their price to sales is less than a third from a valuation perspective. And then what about earnings? The S&P 500, the average earnings growth rate, the earnings growth of the S&P 500 is 11%, and the average PE ratio is 30.5. So you're paying 30 and a half times earnings based on an earnings growth rate of 11%. At GameStop right now, you're paying a PE of 10 or 11, but in just 2 quarters, if the market cap stays where it is right now, in just 2 quarters, that PE is going to be like 3. For an earnings growth rate that we literally just saw is over 1,000%. So your earnings are growing 100 times faster than the S&P 500's earnings, 100 times faster, and yet your multiple on that is less than 10% of the S&P 500. Earnings growing way better, and the valuation is way lower. Again, does not make sense with reality. And anyone that would use their head, like if you were just thinking about buying a business, like if you wanted to buy a business and you had 2 options, and I said, hey, like forget about the stock market, forget about beating the stock market. Okay, just think if you were going to buy a business in real life, okay, for your job. That's what you want to do in life. You want to be a business owner. Say, okay, here's a business. It's growing at 10% a year. I'm going to ask you to pay me 30 times earnings. And when you factor in the 10% of earnings growth rate, as long as you can continue running this as well as I do, then hey, you'll break even in year 24 or whatever it is. Here's a business. Hey, earnings is growing 1,000%. 1,000% earnings growth. So hey, even if you can continue, like if you can operate this the same way that I have, I'll sell this to you for 3 years earnings. Based on this earnings growth rate, you're going to break even in about a year and a half. So you'll get all of your money back in a year and a half versus you'll get all of your money back in 24 years. Which business would be more attractive to you? By the way, this one over here is very complicated. There's a lot of specialties you need to know, right? It's business to business, or it's tech, or it's a lot of development. It's a lot of expensive employees, a lot of talent. This one over here, hey, it's just stores, and we just sell trading cards and video games. So, just like stay open. Our employees cost $15 an hour. And by the way, you could close all the stores if you want and just be an online retailer. That would be fine too. So, not a whole lot of rocket science going on. Like, amazing the discrepancy between the fundamental value right now of GameStop compared to its valuation, and the growth rate now of GameStop compared to its valuation, where none of that growth is being factored in, and the business is not being respected at all. And again, every quarter this continues. It might not continue any longer. It might be 2 weeks from now when the warrant dividend is issued, on October 3rd. It could be that, okay, that's the date that now GameStop's worth 45 instead of 25 a share. And that would be like, whoa, that's crazy. I'm like, yeah, it's still worth a fraction on an earnings basis, on a sales basis, on a book basis, it's still trading for, even if it doubles, right, the stock price, it's still trading at a massive discount to its industry peers, trading at a massive discount to the S&P 500 peers, despite having growth rates that are massively exceeding its industry peers and massively exceeding the S&P 500. And by the way, if it does double, well, then it's going to qualify for the S&P 500. Doesn't mean they'll get in the very first quarter. There's still a board that has to approve you. But you start thinking about all those cash inflows. If they've been able to raise $10 billion for free, basically, being a small company, like if there's that much demand for their shares already, how much more demand do you think there would be if and when they're approved into the S&P 500 index? Like it's just not hard to envision the future. It doesn't require something new happening. All the new is just that much more exciting, right? What do they do to deploy some of that cash? That's an exciting conversation. And I have some ideas, but they don't have to, they're not waiting for that to be an exciting investment opportunity. It's like the opportunity is already here. Even if they just stick the cash in T-bills, it's still just like that much more attractive from a valuation perspective. Again, if you were buying a business, and it's like, hey, you can buy this business. And by the way, we have so much cash that even if the whole business closes down, you'll make all your money back in 2.5 years if you just put this cash in T-bills. Like, it doesn't make sense how undervalued the company is, except when you, again, open in the conversation of what is going on with market makers behind the scenes, plumbing the market. Like, how is this stock being this suppressed? How is the derivatives market this in control of the stock market? Like what is causing the discrepancy? That's a conversation for speculation. But is there a discrepancy? Yeah, it's not hard to see that the company is fundamentally performing much better. A lot of the transformation is well underway, and seeing the fruit of it, and it's just going to get better just from the core operation perspective. And yet they're worth less now than they were 3.5 years ago when none of.
So that was the bulk of it. I had to play it at a faster speed. I apologize, guys. And no disrespect to Jeremy, who did all the hard work there. Shout out to Jeremy and his channel. Once again, it is Budget for Life, all one word. And I'll tag it on the header when I post this. I just wanted you guys to see it from, he's a certified financial analyst, whatever. He's real, but he's not asking for any money here. He's just going over the fundamentals of what GameStop is. And without a doubt, GameStop is undervalued. I love it. Every time I see an article where people have it right, I post it. In this case, here's a video. We found it. So thank you to Jay. Thank you for all the research team who finds stuff like this while we're out here grinding in life. I just want to say thanks again, guys. You guys got to watch this twice. Watch it twice. What we were telling you is this, and I want to explain this to you, what I've said. The cash is the market price, right? Everybody knows. You have cash that's undeployed. That's the market price. Great. Here's what GameStop's worth: $25 a share. The cash is $25. You cannot buy GameStop, the company that generates $500 million for $5. That's the point here. This is what he's telling you, that if you were given multiples, if there were other companies like Best Buy, like Costco, like Chewy, whomever, if they had the type of cash GameStop has, if they had the type of transition and pivot and growth, then it would be talked about. We're talking about double-digit growth in free cash flow and profit margins. Even ops was almost double digits, if I'm not mistaken, but it is very close. But we know what we have. If you don't know what you have, don't let anybody try to talk you off of this. They're all trying to buy it at a low price. They're all trying to get you out of it. These warrants that are going to be deployed upon you as an investor, just understand that it's a reward. It's an award. It's a reward for holding for so long and doing the right thing. Stack as many shares as you can. And my challenge to all people out there is, show me how many warrants you have. Yeah, I'm talking about content creators. Exactly. So anyway, you'll see what we're going to do, guys. This company, this stock is going to be everything you want it to be. If you have not envisioned it going, 10x from where it's at today, remember your market cap, what you own on this stock. As you can see here, it's not even trading at 10x, and it should, just based off the fundamentals. And that's at the beginning of it. That's today's valuation. We're not even projecting what it will be with power packs, because I'm telling you right now, the impact of power packs and a new product, it has a huge influence on you, on the stock, on this company, because we don't have many things. We have a couple of consoles, we have a couple of video games, and then we got a whole lot of Pokemon cards. But all that cash and everything we do with it, how we actually get those dollars and generate that, that's the website. That's the new website, and that's the new products. So keep doing what you're doing, guys. GameStop is fundamentally undervalued, and here's another CFA to tell you that. They figured it out, and I'm going to show it to you every time I find it, okay? Shout out once again to Budget for Life for a great video. Peace.